Well, good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management. And of course, how all this impacts our decisions on the best courses of action for your investment strategy and financial goals. Well, thank you for taking the time out of your busy schedules to join us. We are recording this so that those who can't join us live can tune in when it's more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock, and our financial planner, Bianca Tomlinson, is also with us. We'll have a Q&A period at the end of the call, so if anyone has a question about portfolios or any aspect of wealth management, we certainly invite you to feel free to ask us questions. Once again, I am live from beautiful Point of Barrel, Ontario, and the northeastern shore of Georgian Bay, away from the office, but always tuned in, of course, making sure that we're looking after our clients and their portfolios as markets are active 24/7. A special welcome to some of our new listeners. And just a little overview for you. High Rock was founded by Paul in 2010 to manage about $200 million in closed-end funds for Scotiabank, and we are registered with the Ontario Securities Commission. I joined Paul in April of this year to help build our private client business, and we're off to a great start. We continue to add new clients, and we're very excited to have made an impact in such a short time frame. If you like what we are doing, our approach, our service, and our expertise, feel free to recommend us to your friends, family, and colleagues. We do have room for new clients who might be a good fit for our style of investment and wealth management. Our private client division was established to take advantage of some of the synergies that come with the funds we manage for Scotiabank. Now, we are not brokers, we are not investment advisors, or we are not financial advisors. We are a portfolio management company who has a clear understanding of wealth management. And very importantly, all of us at High Rock have all our money invested in the same models as our clients. So whatever we do for all of us. Our interests are aligned with yours. Our fees are simple and transparent, and we take our responsibility to you beyond that which is required by the regulators, with an independent review committee that reports directly back to our clients to ensure that we are walking our talk. You will be receiving the first report shortly. I've seen the report. We will be putting together our quarterly updates for our clients, and that independent review committee report will be accompanying them as we send them out later this week and next. Okay, so let's move to the risk analysis section of our weekly calls. Here we're always seeking the most efficient way to maximize return while at the same time minimize risk. Our goals for your portfolio strategy are to get the best possible returns and take the least amount of risk, and of course to do this in the context of your goals and your tolerances for risk. Our measure of risk, annualized standard deviation displayed on the horizontal axis on this chart, shows risk as it increases from left to right. And of course, a pure equity portfolio like the S&P 500 or the S&P TSX indices certainly can attain potentially higher levels of growth. However, there is also greater potential for higher levels of volatility and risk in that approach. In comparison, our research shows that a globally diversified and balanced 60% equity, 40% fixed income model can significantly reduce the risk and still achieve an annualized return of somewhere between 7 and 8% over a multiple year period. So this is what we consider to be an optimal portfolio. At High Rock, we have three models with which to create balance and diversification. A fixed income model, which will have bonds, a small percent of which might be high yield bonds, which we discussed last week in some detail. And we also include preferred shares here as well. We have a global equity portfolio that focuses on diversification across thousands of companies in multiple economic sectors and across many geographic locations as well. We have a model that focuses on Canadian small to mid-sized companies with which we have a great deal of familiarity and deep levels of research. This is an active or tactical model intended to obtain better than average growth. For our clients, we use these models, all of them to combine to create portfolio strategies that are in keeping with your desired goals. Okay, so on to our broad themes for 2015. I've talked about this a lot, but this is a year that we should expect surprises, and we've had lots of them so far. We think we're going to get more as the year progresses. Another one of our themes is to be monitoring the oil price shock repercussions. Oil prices collapsed at the end of 2014 and the beginning of 2015. Hit their lows, bounced back to get close and stabilize near the $60 level recently. But then the deal on Iran's nuclear future has shifted somewhat the outlook for oil prices as sanctions and embargoes are planned to be lifted. As a result, oil prices have dropped and back towards that $50 level. So again, something needs to be considered, but certainly it's had its implications on the Canadian economy, which has already been struggling, and the Bank of Canada last week dropped the bank rate by 0.25% in an effort to try and stimulate the Canadian economy. But both the drop in oil prices and the bank rate cut impacted the Canadian dollar quite significantly, and it certainly heightened our currency risk awareness levels. And we had been experiencing a rather stable Canadian dollar, although lower, and then as the year progressed, the Canadian dollar started to move a little higher as oil prices bounced back. But lately, with the double whammy of oil prices and a decline in the bank rate, Canadian dollar has hit new lows. As well, our assessment of interest rates and what may be next for the Bank of Canada, some are actually suggesting the possibility of another rate cut depending on how the economy evolves next. But certainly we've seen the Canadian yield curve steepen as short-term rates again are lower, and that is in keeping with the current situation in the Canadian economy. So again, something that we're keeping our eyes on, but that steeper yield curve to us means that we have to be a bit patient waiting for opportunities to buy bonds. In his monetary policy report and the press conference that followed last week, Bank of Canada Governor Paulos reiterated his belief that a stronger U.S. economy in the second half of 2015 should improve the potential for the Canadian economic recovery, especially in the non-energy related sectors. However, that would mean we will need to see some significantly better U.S. economic data. At the moment, 2/3 of the U.S. economy, which is consumer-driven activity, is not growing. Certainly, evidence from retail sales activity has shown slowing. And we discussed this last week, but June retail sales data showed a decline. We think that this change in consumer attitudes is going to be reflected in the longer-term ability of the U.S. economy to lead the global economy. Right now, we've got the baby boomer generation saving for retirement, while millennials just have less money to spend. So that theme of lower consumer activity is something that we think is going to be crucial and may, in fact, come into play in what happens next as far as the U.S. economy is concerned. Okay, well, so let's look at another one of our themes and talk about the latest data on inflation. Last week, we reported that UK inflation had actually dropped to zero. But last week, later in the week, we saw an update on Canadian core CPI, which showed a slight uptick. But generally, Canadian inflation has been rising as the Canadian dollar has been falling. And that's something that obviously is something the Bank of Canada has to keep in mind. Now, they think that inflation is somewhat less than what the core is showing, and something that they discussed fairly widely in their monetary policy report last week was the output gap, which shows that the Canadian economy is underperforming, and therefore the Bank of Canada doesn't see core CPI as an issue. Again, something that we have to keep an eye on, because the last thing I think the Canadian economy needs is to have slow growth and higher inflation. In the U.S., we saw core CPI pretty steady over the last few months, even though core CPI jumped up a little bit in its most recent reading, but nothing I think that's going to make the Fed become alarmed. And of course, the Fed monitors the core personal consumption expenditure index, and their target for that is 2%, and we'll see how that comes. That data will be announced a little later this month. In the euro area, inflation ticked down a little bit, but inflation has bounced back and stabilized at lower levels. So it appears that the deflation scare has subsided, at least for the moment. That certainly is a positive and reflects on the aggressive monetary stimulus that the European Central Bank has been putting into the European economy there. And we also need to talk about gold, because anybody who is looking for gold to bounce has been disappointed, and those that have given up waiting are starting to sell, and it's been driving gold to new multi-year lows. And of course, this has had its impact on the S&P TSX, despite the recent positive impacts from lower bank rate and the Greek resolution. So we're closely monitoring the implications of all of this on the market risk, certainly watching what's happening with the gold producers on the TSX. Okay, and another one of our themes is the U.S. Federal Reserve. Our expectations are that they would raise rates possibly in September, and much like Bank of Canada Governor Paulos, Fed Chairwoman Janet Yellen is rather upbeat about the outlook for the U.S. economy in the second half of 2015, and she has continued to suggest that there will be at least one interest rate increase coming before the end of the year. Perhaps September, but again, the Fed is data dependent, so they'll be monitoring economic data between now and certainly between now and September to determine when they should start to normalize interest rates. Well, how is all this affecting bond markets? Well, we saw the Canadian bond market, the Canadian yield curve, and how it's been impacted. Certainly in the U.S., expectations of higher interest rates have taken bond yields higher in the long term, and in the short term, the 25 basis point increase has already been built in. Certainly in Europe, bond markets have calmed with the Greek resolution, and also with the stabilizing of the rates of inflation, although bond investors continue to be concerned about what the future holds. And that is certainly evident in the negative yields that are pervasive in the short-term German government bond market. Finally, as far as equity markets are concerned, well, we're now into second quarter earnings season. Approximately 12% of the companies of the S&P 500 have reported results for the second quarter. Fewer companies are reporting EPS above estimates and sales compared to the 5-year averages. So in aggregate, companies are reporting earnings that are ever slightly above estimates, but estimates were for about a 4% decline. So we're pretty much on track for that. Mind you, we are still early into the season. It's a big week this week with about 131 companies reporting. As for the future, looking at future quarters, analysts are now calling for year-over-year declines in earnings to continue through the third quarter, and year-over-year declines in revenue to continue actually through the fourth quarter. So again, from a fundamental perspective, Paul and I think stocks are expensive. We believe that share prices are expensive relative to company valuations, and it's basically a supply and demand situation where share buybacks have reduced the supply of equities, and investors looking for better returns have increased their exposure to risk and have been buying equities. So there has been greater demand and less supply, and that's been the factor driving prices. But as we tend to want to make sure we include the fundamentals in our overall viewpoint, we think that there's something a little amiss in the current level of prices. So again, we think that even though equity markets have calmed down following the Greek resolutions, the fundamentals aren't lining up, and it's just giving us reason to remain cautious. So how are we positioning our portfolio models based on our current assessments? In fixed income, while volatility has settled in the bond markets, we continue to look to add to bond positions, but only when we see yields moving higher and prices moving lower. So again, being patient there. In our global equity model, volatility has eased up. As I said, markets are higher with the Greek resolution. Most of the short-term downtrends that the Greek situation created have been broken out to the upside as the relief rally came about. But again, we think that there will still be better opportunities in the fall, and so we're prepared to be cautious. But let's have a look at what's been going on. Japanese equity markets resumed their uptrend. The UK equity markets bounced from the lows prior to the Greek resolution, breaking through, as I said before, that downtrend line. We'll continue to monitor to see how that, what the follow through is there. Same idea in Europe and in Australia as well. Looking to our China and emerging markets, China's equity markets have stabilized, and so too have the emerging markets, although emerging markets are still remain in their downtrend at this particular point in time. So once again, lots of caution. We see reasons for lots of caution, and we'll be proceeding accordingly with our client portfolios. As far as our Canadian growth equity, let me see if Paul's got anything new he'd like to add to the conversation.
Thanks, Scott. Really no change. I mean, you've spoken about value across the globe, and it's really no different in the Canadian small mid-cap space right now. We are treading pretty carefully. We have made some buys and some sells. We've got a couple that we're working on positioning, but doing so with some caution. So that's our number one goal here, is to own some stocks at reasonable values and it's, or valuations rather. And it's hard to come by right now, so we are treading cautiously.
Thank you, Paul. And that's really it for today. We're, as we've been emphasizing, being rather cautious about what we're seeing out there, and as a result, again, we think that when we determine that caution is the better way to be, we're being a little overweight than our normal targets would be in cash. But we do see the potential for opportunities developing in time, and we will take advantage of those when they come. All right, well, that's it for today's discussion. If there are any questions, we'd certainly like you to voice them at this time now. All right, well, if you are listening to this call on the recorded version and you do have questions, please don't hesitate to send us an email or give us a call. We're always open to having a discussion. And one thing I should add is that more often than not, if one client has a question, there probably are a number of clients with the same question. And it always gives us good topics to focus on for our weekly calls if we get a question or two. So please feel free to send your questions our way. But that's it for another week. So thanks for taking the time to tune in. Have a wonderful rest of the week. Have a great weekend. Hope everybody's enjoying the summer. And we'll return with another webinar next Tuesday. So this is Scott Tomlinson signing off.